A trust conversion may sound complicated, but when you learn how a trust works, you'll have a better understanding of its conversion function. A trust is a property management arrangement under which you entrust the management and disposal of your property to someone else, with the intention of turning it over to your family members or others. When you set up a trust, you will become a settlor. How does your right to your property change before and after setting up a trust? Before you create a trust, you have the ownership of your property and other rights to determine its fate. When you set up a trust, the ownership of your property is transferred to a trustee who is entrusted with the trust. After that, the trustee manages and disposes of the property as its legal owner. In a trust, your family members or others are designated as beneficiaries and acquire beneficiary interests. This means they acquire not the property itself, but beneficiary interests in it. To make this point clearer, think about a case in which you designate yourself as a beneficiary of the trust you set up. In that case, you have converted your property into a trust beneficiary interest of a different nature. Again, a beneficiary acquires a beneficiary interest when a trust is set up. A beneficiary interest consists of two subordinate rights. One is the right to receive a trust property and benefits such as income arising from it. The other is the right to protect a beneficiary's best interests and oversee a trustee. You can't split a beneficiary interest into those two subordinate rights and transfer each to two parties. A beneficiary interest represents a beneficiary's right to claim against a trustee, and its legal nature is comparable to a claim as defined by the Civil Code. In other words, when you create a trust, your property is converted into a claim against a trustee. This is called a trust conversion function. A beneficiary interest is transferable. A settlor is allowed to sell a beneficiary interest to investors, for example, to raise funds. Investors use the beneficiary interest to invest their money for profit. When a trust property is converted into a monetary claim from which to receive monetary benefits, a variety of financial instruments can be created by exploiting the cash flow generated from the trust property. With their nature and conversion function of beneficiary interests, trusts are a useful way to securitize properties. A prime example of monetary claim trusts that take advantage of a trust conversion function is mortgage loan trusts, first created in Japan in June 1973. In those days, housing finance companies, many spun off from banks, depended solely on the borrowings from financial institutions for operating funds. But they needed to establish their own sources of lending insusceptible to the volatility of financial markets. They also needed to have long-term, dependable funding means to avoid interest rate risks associated with offering fixed-rate mortgage loans of 15 to 20 years. It was against this backdrop that a mortgage loan trust was developed. It was an arrangement under which a trust bank is entrusted with all mortgage loan claims owned by a housing finance company and sells the beneficiary interest received in return to investors to raise funds. The combined balance of mortgage loan trusts had peaked at 625.1 billion yen before plummeting when most of the housing finance companies collapsed following the burst of the bubble economy in the 1990s. In recent years, the balance of mortgage loan trusts has restored growth as an increasing number of financial institutions have been entrusted with such trusts, and the Japan Housing Finance Agency has taken over the remaining claims in the Flat 35 housing loans financed by financial institutions. Other types of monetary claim loans have gained popularity since the 1980s among businesses intending to compress their assets and write them off from their balance sheets to improve their return on capital and diversify their fundraising means. To facilitate this trend, the Act on the Securitization of Specified Assets by Specified Purpose Companies, the SPC Act, went into effect in September 1998. The SPC Act allows the creation of a transfer-type securitization scheme that uses specialized purpose companies. In addition, the Act on Securitization Assets, effective in November 2000, legalizes trust and association-type securitization schemes. These regulatory developments have accelerated the securitization of general loan, lease, and credit claims. Moreover, accounts receivables trusts, which securitize accounts receivables owned by businesses, and the securitization of loan claims owned by financial institutions have emerged. Neither of them is backed by any specific laws. The Trust Companies Association of Japan reported the combined balance of monetary claim trusts had reached 43.5 trillion yen as of March 31, 2021. A monetary claim trust is an arrangement under which a financial institution or a business serves as a settler and entrusts its monetary claims to a trust bank to raise funds. Types of monetary claims include loan claims, accounts and note receivables, and lease and credit claims. Trust beneficiary interests are considered securities as defined by the Financial Instruments and Exchange Act. Businesses sell trust beneficiary interests to investors to raise funds through trust banks that handle the transactions of such beneficiary interests. A trust bank exercises exclusive control over monetary claims as trust property. The bank may recover debt directly from debtors, but it usually leaves debt collection to the settler financial institution or business from the beginning. This is called a silent scheme. It's useful when a settler wants to raise funds without telling debtors that their debt has been used to set up a trust, which, if revealed, might jeopardize the business relationships between the settler and the debtors. A beneficiary interest in a monetary claim trust is a performance-based profit-sharing instrument with principal not guaranteed. Investors buy their share of the interest at their own risk, including a bad debt risk associated with the monetary claims. To reduce investors' risks, credit-enhancing instruments may be incorporated into a monetary claim trust. For example, a settler is obligated to buy back or exchange unrecoverable monetary claims, or a priority and subordinate structure is applied to beneficiary interests. Under a priority and subordinate structure, beneficiary interests are divided into those with a higher priority in receiving the payment of principal and income, and those with a lower priority. Investors are sold only the priority beneficiary interests. Monetary claims are not the only assets to be securitized. Movable properties, real estate properties, and intellectual properties can be securitized. Among those, real estate is the most popular form of property for securitization. Real estate is a low liquidity asset by nature, requiring complicated procedures and high costs for transaction and distribution. It was long considered as a hard to securitize asset. That changed when the Act on Securitization of Assets became effective in November 2000. Since then, many real estate properties have been securitized to make them high-yield investment destinations easy to buy and sell. The growing popularity of the securitization of real estate properties has been partly driven by businesses' need to improve financial performance, such as return on capital, by compressing their assets and writing them off from their balance sheets. It's also driven by Japanese and overseas investors' need to invest in commercial real estate, such as office buildings, commercial complexes, and hotels, to gain higher yields in a low interest rate environment. To meet the increasing need to securitize real estate properties, a scheme under which an SPC or an investment association is set up to raise funds and invest in real estate. Real estate trusts are also intended to meet such needs. Under these schemes, beneficiary interests in real estate trusts, not physical real estate properties, are made investment destinations. This is intended to streamline the process for acquiring or disposing of commercial real estate properties to save on transaction and distribution costs. Real estate investments take a variety of forms. A typical one is what's called the GKTK scheme. It's an arrangement under which an operator of the real estate investment business establishes a limited liability company that takes care of investment and at the same time sets up and operates an anonymous association of investors to solicit contributions from investors. The limited liability company uses their contributions and borrowings from banks to invest in real estate. The whole process starts with a real estate owner creating a real estate trust in which the real estate property to be securitized is turned into a trust property. The real estate property in question is then transferred to a trust bank, which serves as a trustee and the legal owner of the property. In return, the original real estate owner acquires a trust beneficiary interest. The original owner then sells the interest to a limited liability company to compress their assets and raise funds. An operator of the GKTK scheme can save the trouble and cost associated with selling and buying a physical real estate property by acquiring a beneficiary interest instead of the physical property. The operator can focus on the real estate investment business by letting the trust bank continue to professionally manage the entrusted property. Investors have the option to sell the beneficiary interest to other investors to recoup their invested money or to terminate the trust and place the property under their direct ownership. A trust conversion function enables a real estate property to be converted into a beneficiary interest, which is easier to acquire, manage, and dispose of. Let me explain more about what makes trust schemes attractive to those who want to securitize real estate properties. First, in a real estate trust, investors can gain essentially the same economic benefits from acquiring beneficiary interests from the property owner as from taking over the ownership of real estate properties such as office buildings, commercial complexes, and hotels from the owner. In the latter arrangement, investors will have to go through complicated processes for concluding a contract and completing a registration. Investors can save the trouble and costs associated with selling and buying real estate properties. In addition, investors have the option to sell their beneficiary interest to other investors to recoup their invested money. Secondly, investors can leave the management of buildings, equipment, and tenants, which comes with owning the property, to a trust bank. Investors may be experts in the investment business, but don't have the skills or staff for real estate property management. Therefore, it makes better business sense for them to take advantage of a trust bank's expertise and know-how in property management. Thirdly, investors who buy and sell beneficiary interests in a real estate trust are exempt from real estate transaction taxes, such as a real estate acquisition tax and a registration and license tax, which are imposed on transactions and ownership transfer registrations of real estate properties. However, when a real estate trust is terminated, an investor will have to pay a real estate acquisition tax upon receipt of the real estate property previously set up as a trust property. And an investor who buys a beneficiary interest from another investor will also have to pay such taxes upon receipt of a physical real estate property. The securitization of real estate properties is not just for investment purposes. In recent years, some businesses, instead of selling off their own head office buildings, have set up real estate trusts for them and sell acquired beneficiary interests to privately place funds to raise money. Under this arrangement, businesses continue to occupy and use the buildings by leasing them back from the funds. The Trust Companies Association of Japan reported the balance of real estate funds for securitization purposes had amounted to 49 trillion yen as of March 31, 2021. Real estate funds have become an integral part of the securitization of real estate properties. A land trust is a variation of real estate trusts. Its purpose is not to securitize or manage a real estate property, but to use it to operate the leasing business for profit. That's why a land trust is categorized as a business-type trust. A land trust is an arrangement under which a landowner serves as a settlor and entrusts their land to a trust bank, which serves as a trustee, to get the most out of the land and make profit from the leasing business. It's also called a lease-type land trust. Under a trust agreement, the trust bank uses the funds it raises to build an office building, commercial complex, or a hotel on the land to start the leasing business. Part of the profits arising from the business are returned to the landowner, who is a beneficiary, as trust dividends. And in a disposal-type land trust, a trust bank develops the entrusted land for sale in lots or constructs a building on it and sells it along with the land. Part of the proceeds from the sale are returned to the landowner. A land trust takes advantage of the expertise and know-how a trust bank has in the real estate business. Unlike a real estate trust designed to securitize a real estate property, a land trust is intended to make profit from the land. It's a trust that benefits from a wealth of professional knowledge and experience a trust bank has accumulated as the only financial institution type allowed to operate the real estate business under Japanese law. The first land trust was created in Japan in March 1984. Since then, land trusts became widely used by individuals and businesses, as well as for government and publicly owned land with the help of private sector players. Following the burst of the bubble economy in the late 1990s, however, the number of active land trusts declined amid falling profitability and land prices as a result of an economic downturn. The Trust Companies Association of Japan reported the number of active land trusts was down to 241 as of March 31, 2021. Let's take a closer look at how a land trust works. When a landowner seeks a trust bank's advice on the profitable use of their land, the bank inspects the property and considers its potential use. After completing market research and a feasibility study of the leasing business model, the bank puts together a construction plan and a business plan to be presented to the landowner. As each piece of land is unique unto itself, these plans address the uniqueness of the land. When a trust bank is to be entrusted with the land, it weighs a variety of factors, such as the land's topography and location, as well as regulatory restrictions on it, in a proposal presented to the landowner. In a land trust, dividends are paid based on the performance of the leasing business. Therefore, the bank's business plan must address fluctuation risks of lease income and interest rates caused by changes in economic and financial conditions. If the bank determines that the proposed land trust has a good chance of success, it negotiates with the landowner over the business plan and terms of the trust. If both parties reach a consensus on all points, they enter into a trust agreement. In accordance with the agreement, the trust bank then concludes a contract with a construction company and places a construction project order with the firm. At the same time, the bank borrows money from financial institutions. It also negotiates with potential tenants of the buildings and concludes lease contracts. This is part of preparing to launch the leasing business. When the business is completed, the trust bank manages or has a service provider manage the land and building and deals with the tenants, rents, and expenses. A land trust is an arrangement unique to Japan, under which a trust bank meets a landowner's need to make profit from their land without losing its ownership by conducting the leasing business on their behalf, using its expertise and know-how in the real estate management business. Land trusts will likely remain a popular land development scheme. This concludes my presentation.